Are you looking to make trading Forex an easy experience, especially when it comes to understanding the Pips versus Pipettes discussions and average volatility movement? Rest assured this video has got you covered because we're going to go into the details that are necessary to understand what markets you should be trading each session and why. Sean Kozak here, tuning in again with NeuroStreet Trading Academy, and for the world's best trading education and strategies, be sure to hit that subscribe button, turn that notification bell on, that way each time we put out content like this, you get results. Give me a thumbs up, that way I know you're engaging in the content, and we can make sure that you ask a question or leave a comment below. Now, one of the things that I want to talk a little bit about that differentiates successful traders and novice traders is successful traders understand their market, but more importantly, what's driving movement. Volatility and average pip movement is critical because not every market's going to have huge moves every day, and we want to make sure that we're taking trades on the best moving markets on the right opportunities. And that's exactly what we do when we do in our trading room, is we focus on only the key markets each day so that you're always right for the picking. Now, we're going to talk about 3 discussions. You say 3, that's not a lot. Truthfully, it's a lot. We've got a lot to cover in this video because these are major topics and we want to make sure that you understand them completely. Pips versus Pipettes. Forex moves in pip increments, but depending on the platforms that you're trading, some of them move in what we call sub-pip pricing. So we want to make sure that you understand the price movements between each of the assets that you're trading and how trading on different platforms can affect the way your position sizing goes for the market. Then we're going to talk about FX terms and jargon. And I don't mean just basic terms. I mean leverage terms, brokerage terms, platform terms, market terms, everything that you need to know so that when we're in a live classroom and you're watching instructors trade, you understand the lingo. Then we're going to go into my favorite of all discussions, and this is really important for you to know, is average pip movement per market session. Depending on when you're trading, whether you're trading in the Asian session or the Aussie session, maybe you're trading in the London, UK session or the New York session, every market has an expected movement, also known as the average pip volatility movement for that market. And we want to make sure that you know the best markets at the right times during the right sessions so that you're not sitting there trying to trade a dead duck. What is a dead duck? A dead duck is something you never want to be in a trade in because it's not moving, and when the markets aren't moving, you can't make money. And we're here to make money, so we want to make sure we're trading the markets that are always moving the most, and that way you know how to do that. So we're going to jump onto the screens. I don't want to waste any more time here. We got lots to cover, and like I said, if you have any questions, make sure you leave them below. We'll see you on the charts. Welcome back, traders. In this video, we're going to be breaking down Forex Explained Part 3. The main discussion for today's video is breaking down the difference between pips and pipettes and how we basically look at pricing Forex pairs. So the first discussion here is going over what is a pip and what is a pipette. A pip is considered percentage in point, and a pip is measured as the 4th decimal point of the exchange rate, so 0.0001. An example would be the pound dollar. Okay, let me just grab a little draw tool here so you can see it. The pound dollar would be the pound dollar, which is 1.4605. The 5th is the 4th decimal point. This is the pip increment that we're talking about. That's actually the pip that we're trading. So we're actually trading this decimal place on the currency exchange as that changes throughout the price fluctuations. The 0 is the tens unit, the 6 is the hundreds unit, and the 4 is the thousands unit. Now the only exception to this is when we include pairs that have the yen attached to it. And the yen only ever has 2 decimal places just due to the valuation of the yen. And the yen, you know, the 7 would be the pip that we're trading. So the 2nd decimal place. So in all other pairs, the pip is the 5th decimal place. And then in the yen, it's the 2nd decimal place of the right of the decimal. Now you can see here, this is a great example of 1.6370. The 0 is the pip. If this went to 1, then we say that Forex pair gained 1 pip in valuation, right? If it gained 2, it'd be 2 pips in valuations, right? Now the other side of this is pipettes. Now the reason we bring this into discussion is some platforms will price their Forex pairs in pipettes. We'll break a pip down into increments, right? 10 pipettes into 1 pip. And similar to like ticks with futures, you've got ticks per point, right? Well, this is pipettes per pip. And so you will find that some platforms and select liquidity providers are quoting prices in sub-pip format. This is 1/10 of a pip, commonly called a pipette. And a lot of brokers will notice this as the 5th digit pricing model. An example would be the pound dollar if we were looking at 1.46057. The 7th is the sub-pip pricing that we're actually talking about. The only exception is when we include the Japanese yen, like we were just explaining, and that would mean we'd have an extra decimal, which is a 3rd digit pricing. So if we're looking at the dollar yen, it'd be 91.573. And this 3rd decimal place is the pipette that we're talking about. So you can see here, this would be considered the pipette over here. So the main thing here is how does it look on a chart, right? How does this look like on a chart? And so if you're looking at this, you can see that this is a pip and pipettes on the euro dollar. You can see we're going from 1.1311 all the way up to 1.1312. That is 1 pip in movement, which is 10 pipettes. Okay, so that's basically what this looks like and how that is referred to. Okay, another example here on the yen. If you're looking at the yen, you're going to see here that the yen has, it's the euro yen, it's looking at 1.20.49 all the way up to 0.50. And then we have, that's 1 pip to 1 pipette. And it really just depends on the platform that you're using and the way in which this is breaking down. But the nice thing is that it's actually quite simple. It's just knowing the different terminologies and how the market's moving in fluctuations. So I'll give you an example. Let's go take a look at the Aussie dollar. So the Aussie dollar is moving right now. And if you look in here, you can see if we break this down, you can see that this is a NinjaTrader platform. NinjaTrader is moving it in pipette decimal points. As you can see that there's actually, if we were to go from 0.7281 to 0.7282, that's 1 pip. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 pipettes, 1 pip. But you can see the pipette valuations is in here. And not all platforms do that. Some platforms don't actually show the pipettes, but some platforms do. And it really just depends on, which program you're using. And we're using NinjaTrader, TradingView, TradeStation. These are primary platforms. Not TradeStation for Forex, but TradingView, NinjaTrader, and there are other platforms as well. But I just want to let you know that that's exactly how you break that terminology down, right? So let's go in here and talk about the spreads a little bit, so that we can kind of explain how this works. There's always going to be a bid and an ask spread because all pairs are quoted in 2 prices. You have a bid and the ask. The bid is lower than the ask price. The bid is the price the broker is willing to buy the base currency in exchange for the quote currency. The bid is the bidding price. The ask is the asking price. The ask is the price the broker is willing to sell the base currency in exchange for the quote. The difference between these two is what we call the spread. Now, the spread on majors, the major most liquid pairs, is anywhere between 1 to 4 pips depending on volume and liquidity. And, normally, depending on how this works, it's, pips or pipettes, just depends on that. But the big thing here is making sure that you're always aware. And that's why you don't see a lot of scalpers scalping Forex as much as you would on other markets because of the spread. Normally, you're going to be trading day trading or intraday swing trading on Forex just due to the spreads, right? An example here, if you're selling at the bid at 1.4460, you're buying at the ask at 1.4463, you're going to have a spread of 3 pips, right? You can see that differentiation between the two. An example on the yen, you have 101.89 and 101.92. You can see the 2 decimal points. We have a 3 pip spread. Remember, the yen is only dealing with 2 decimal points where all the others are dealing with 4. And the reason for this is just understanding the difference between the bid and the ask. And really how this works is it's a price ladder, right? All price ladders are like this, and you're always bidding to the asking price. The buyers are on this side, the sellers are on this side. You're always going to have a bid and the ask spread. You're always going to have that differentiation between the two, which is what's creating the spread. So when we look at this from a liquidity provider, the market's moved due to liquidity of supply and demand. Order flow is the liquidity of the market. However, FX, there's always an equal buyer and seller in every trade. If this is true, it poses the question, how do prices move? Well, to the right is an example of a bid-ask table. Okay, some platforms call this the dome or the price ladder. The bid is what someone is willing to pay, and the ask is what someone is willing to sell. And so you can see that there's 5 people willing to buy at 130 here, and there's 10 people willing to sell at 130.03 with a 10th. There's a 3 pip spread between the buyers and the ask, but the quantity is different. This is not just a difference in the spread, but also in the quantity. So you can see that there's differentials between the bid and the ask amounts, but also in the spread, which is what creates that imbalance between supply and demand. And so if we break this down a little further, what ends up happening if a buyer is willing, a buyer will often increase what he's willing to pay, so he'll move his bid up, and then a seller will normally drop down, and this will normally produce a trade in the middle, right? And they'll meet in the middle, and that's where the facilitation of trade takes place, right? Sometimes when traders want to get in immediately and they're not willing to wait, they just will enter at market, and this is normally when large supplier demand happens, normally around news or any fundamentals. And what can take place is this can ultimately change the spread and also the price quantity between them, right? But the main goal here is, if there's 2 left over, like on that situation, I'll kind of go back and show you. This would mean there's 5 and 10, right? Well, let's say the middle is 3, okay? And then what ends up happening, that means there's less quantity, but there's still remainders, right? So what ends up taking place is what ends up happening is the new price level has to come in, and then the market has to drop the prices in order to execute the trade. Now, this happens on a much larger scale, and I find sometimes when traders look at it like this is, it gets rather convoluted and a little bit exhausting to kind of think about, how complicated that could be. I'll give you an example of how this would look on a price ladder. I could just grab a dome. We'll just grab a super dome here, and I'll show you. I'll just grab one of the majors so that we can, and this is just an example here. We're gonna grab a Forex pair here, and I'm just gonna grab the Aussie dollar. Okay, so you can see that this is a dome, right? And what's happening here is you've got the sellers up here, and you've got the buyers down here, on the buyers and the ask, and you can see that this is there's the spread. There's you've got prices moving up and down. Okay. You can see this is the quantity. They're moving diagonally, and sometimes the spread and the quantity will change, and the amount of quantity will change, and so I just think that it's really important to just know that you don't really need to worry so much about all that. You just need to know that ultimately, you're just responsible for buying and selling, right? If you're going to be doing that, you're going to be putting in buy orders and sell orders. You don't have to worry so much about what liquidity's left, because we're not sitting there scalping level 2 data. This is the Forex market, right? Your most important thing to worry about is, where am I getting in for a proper trade, and where am I reducing risk and money managing my account, right? And that's why you're here at the school, is we're going to teach you those strategies. But a lot of traders, they want to understand what's causing the price movement in the Forex market, and it has to do with the spread, and it has to do with the bid and the ask and the movement of price, right? Another example is if you have a chart trader here, you can see that there's a bid and the ask here. You can see there's a 2-tick spread right now. There's a 2 pipettes spread, excuse me. You can see the spread between this is 1 pip right here. So you can see that differentiation between those variables, right? And that's important to know that, right? That's important to know that the spreads are tight like that. It's not too bad. It's a major, so the major moves between 1 and 4 pip spreads, right? So the big thing here is not to get too worried about the liquidity exchange and why price moves, just understanding the volume and the volatility. So one of the things that I like to talk about is knowing the average pip movement per the market. These were done. We actually coded an indicator that kind of exported the data for us to kind of explain. These are estimates of daily range, and this is called an average pip movement. And we look at each pair individually as well as during each session. You can see in this study that the euro session has the highest FX volatility. So you'll see here that the European markets has the highest numbers, which is the largest amount of pip range. And when the volatility and volume is high, the spreads between the bid and ask become less. Therefore, we rank these sessions from top to bottom. And you can see that the euro is very high liquidity and volume. USA is high liquidity volume, and Asia and Oz is lower liquidity and volume. And so, the main market times for us for trading will be the euro and the
euro and the U.S. markets, right? These are the ones for the majors, right? You can see that there's a little bit more volatility in the European session just due to the overlap, because these overlap and they connect. So technically, they're pretty much equal because a part of the European session connects to the U.S. session, and therefore those overlaps take place. So the main thing here moving forward is just understanding that you understand the pips and pipettes. This is the most important part, so that you're knowing how to the price fluctuations are going up and down on the charts, making sure you understand the decimal places for all of the Forex pairs are 4 decimal places, and then you have the yen, which is 2 decimal places, and the difference between pips and pipettes, right? That's the main thing here. I wouldn't get too caught up so much on worrying about the spreads and the quantities. That's all happening automatic, but it's what's really causing the markets to move up and down, right? So if you have any questions on this or you need any assistance, let us know. As I said before, if you're new to Forex, great, you're on a great start. If you've been around for a while, this is going to be a refresher for you and a bridge on your experience. But you're going to want to stick around, because the final video, we're going to be talking about leverage and margins, and then that'll be your great segue into the education courses, the add-ons courses, and our strategy and live classes. So traders, take care, and we'll see you in the next video.
Welcome back, traders. Now that you know the best markets to trade and why, we want to make sure that you don't miss out on all the other content that we've put out in this series. Below this video, there's going to be links to other Forex videos you definitely don't want to miss. Make sure you check them out. Also, hit that subscribe button and make sure you share this video with a friend so they can learn how to get results just like you. Last but not least, if you want to get social with us or if you need any help, ask a question, leave a comment below so we can reply in due time. Now, let's jump onto the screens. We got lots of other videos to cover. We'll see you in the next video.